Good morning, everyone. Thank you for joining us, and a warm welcome to this webinar, which marks the launch of our this year's sector publication. That publication is broken down into two parts. In the first half, we look at key market trends in a kind of commercial and macro sense. And in the second half of that, we take a look at what's been going on in mergers and acquisitions activity in the sector, both in the UK and internationally. So we'll be aiming to bring some of that to life this morning with this session, which is going to be some presentations, some panel discussion, and then some Q&A at the end. So there should be a Q&A function at the bottom of the screen. There's also a chat box. Try to not use the chat box, please, and try and use the Q&A session. So as you go along, if things occur to you, please drop a question into the Q&A, and we'll come to those later. So we're delighted to produce this publication in association with the CPA again, and also some leading industry players who've input to it. So thank you very much to all of those. This morning, we've got Professor Noble Francis from the CPA with us, and we've got Neil McGill from Cairngorm Capital Partners, who've been a big investor in the sector. And we're going to kick off, and we've also got a number of my colleagues from BDO. So we're going to take you through this today. We're going to kick off with Noble, talking us through what we can expect in the coming months. Over to you, Noble.
Thank you very much, John. Hopefully you can hear me okay. And it's an interesting time to be doing construction forecasts, as you can imagine, and we're very glad to be able to do this publication along with BDO. If we can move to the next slide, and move a slide further. Before we get into the heart of the forecast, it's worth highlighting that construction's had a very sharp recovery since the initial lockdowns, which feel like a long time ago, back in spring 2020. It's very much a V-shaped recovery. So sharp fall in activity, sharp recovery. And construction output is above pre-COVID levels, particularly in certain construction sectors. And if you look at the major construction sectors, then infrastructure activity in March this year was 25% higher than pre-COVID, and private housing repair, maintenance and improvement, which includes renovations, was 28% higher than pre-COVID. So activity within the private housing, repair, maintenance and improvement sector is very buoyant currently. The key questions are clearly what happens going forward. So if we move on to the next slide, it's worth highlighting indications that we have from across the sector, what we have in terms of the key issues. Overall, most firms in the supply chain are expecting strong demand in construction, at least until the end of 2022 Q3. After that, demand is slightly more uncertain, and there's particularly less visibility about demand and growth going forward in terms of new build, housing and repair, maintenance and improvement towards the end of the year and going into 2023, as they're the sectors that are most likely to be impacted by the cost of living increases. But having said that, overall in construction, we still have 2.8% growth forecast for this year. And it's worth highlighting our forecasts are for the volume of construction output growth. And it's vitally important to be forecasting volume, because value is clearly highly skewed by materials price growth and wage growth as well. So within the overall 2.8% growth in construction output this year, industrial is the strongest growing sector, and that's highly skewed by industrial warehouses growth. We're anticipating that industrial grows by 9.8% this year. And then infrastructure, which is already at high levels, and we're expecting it to grow another 8.8% this year, driven primarily by major projects such as HS2, the high-speed rail link, the Thames Tideway sewage tunnel, and Hinkley Point C, which is a major nuclear power station. In terms of key sectors apart from that, private new house building, we're only anticipating growing by 1% in volume this year, which doesn't sound particularly much, but it is still growth, and it's growth with it in volume within a sector in which activity's been growing very strongly over the past couple of years, primarily due to double-digit house price growth. And given that major house builders target margin, the fact that we've had double-digit house price growth means that house builders have been happy to increase supply because they can do that without harming margin. Given that we're expecting house price growth to slow, although still be positive this year, we are expecting 1% growth in house building. The major house builders are likely to grow a bit more than that in terms of units, but smaller house builders are likely to be affected by cost inflation, both on the labour side and materials side. And then if we look at private housing, repair, maintenance and improvement, a sector which, as I mentioned earlier, in March was 28% higher than pre-COVID, we're expecting a 3% fall overall for this year. Activity is still strong there, particularly given that most of the major renovations activity has already got planning. It's already down on the ground or expected to be down on the ground for this year in the next 3 months. That's we're expecting a slight slowdown in private housing RM&I towards the end of the year, but activity is still likely to be strong for the first 3 quarters. And if we move to the next slide, then for next year, we're still expecting 2.2% growth in volume of total construction activity. But again, there's a big difference between the sectors in which we're expecting strong growth. Again, industrial warehouses. Infrastructure, we're expecting strong growth. And then volume of private housing output, we're expecting to grow again by 1%. And the major house builders are likely to be expanding output next year, but it is likely to be slightly slower at the start of next year, as we see the cost inflation impacts towards the end of this year and early next year have an impact. What we're likely to see with the major house builders is that starts are more likely to be affected than completions in an uncertain period, even though demand is strong. Given the high levels of uncertainty about the next 12 to 18 months, house builders, particularly the majors, tend to focus more on completions, finishing what they've already started, rather than starting new developments. And then private housing, repair, maintenance and improvement, again, we're expecting a fall, given that householders are likely to be a bit more risk averse, given increases in the cost of living. But once again, it's worth highlighting, it's a fall next year from a high base, given that private housing RM&I activity is at record levels. If we move to the next slide, it's just worth spending a couple of minutes on some of the key risks out there, given that demand within construction is currently very strong, but there are a number of different uncertainties out there. So if we move to the next slide, imported construction products and materials have clearly been an issue ever since the initial lockdowns, and there have been various supply chain concerns there. The greatest concerns in 2020 and 2021 were over timber availability, particularly softwood timber. Softwood timber issues in terms of availability have eased since autumn last year. But there still remain issues in terms of tightness of supply on plastics and polymers, copper, aluminium, steel, roofing and cladding materials as well. And that's partly reflecting the supply chain issues at a global level and global shipping issues, but it's also partly reflecting the fact that demand is very strong in some of the key construction sectors. It is worth highlighting the semiconductors issue, and semiconductor shortages clearly affect all industries, particularly automotives and IT, but within construction, it particularly affects the supply of smart meters, electrics, boilers, and white goods. And this is likely to continue to be an issue for at least the next 12 months. So expect to see further extended lead times there. In terms of domestic construction products, then the key issues tend to be on the heavy side. So large, generic, bulky products such as brick, cement, roofing products. They've tended to be tight in supply over the last 9 to 12 months. The key issues this year and next year are likely to be about the impacts of sharp rises in energy costs. And we saw energy cost rises in the second half of last year. We've clearly seen spikes in energy costs since Russia's invasion of Ukraine. And for heavy side construction product manufacturers, energy costs tend to be between 25% and 33% of total costs. It's not only construction products that have been an issue, but in some key hotspots of construction activity, labor availability is also a key issue. And since the recent peak of construction output, which was in 2019 Q1, construction has lost 294,000 workers, and that's primarily self-employed workers who are EU workers or early retirees. So overall, the key concerns are going to be, despite the fact there's a very high level of demand in construction, what will be the impacts of these rising costs, materials delays, labor availability issues on specialist subcontractors? And that's particularly firms on fixed price contracts that were signed up to 12 to 24 months ago. If we move to the final couple of slides. Okay, just to highlight the issue around materials and wages inflation. Annual materials price inflation in April 2022, the latest data, was 25%. Clearly, it varies considerably among products. And if you look at the chart on the right, you see that the two greatest products with materials price inflation are steel-related products. That's primarily because since Russia's invasion of Ukraine, there's a slight supply issue. 13% of steel-related construction products come in from Russia or Ukraine, and there's a rise in demand from other sources, which increases prices. In addition to that, steel, you've got spikes in commodity prices, iron ore prices and steel prices, and also they're energy intensive. So there's a sort of triple whammy effect there. Wage inflation in March, which is slightly more lagged than the materials price inflation data, wages inflation was 9.6%. So the biggest issues short term are the materials prices inflation, but wage inflation is exacerbating that. And if we move to the final slide, it's worth making just one point illustrating the effect on specialist subcontractors, which is this chart shows insolvencies, materials costs, and construction output all indexed to January 2020 pre-COVID. And what you see is that construction output is higher than pre-COVID levels, as I mentioned earlier, but materials costs in March this year were 35% higher than pre-COVID. And what that means is that insolvencies are 58% higher. Now, that's clearly highly skewed towards those specialist subcontractors and small contractors, but it's worth keeping in mind that there are certain elements of the supply chain that are suffering, despite the fact that demand is currently very strong and likely to be strong for the next 3 to 6 months at least. Okay, I'll finish with my slides there, but given that we've got Q&A later, I'm happy to answer any questions on the construction output forecasts, short-term or long-term.
No, thank you very much. So, I mean, it sounds like demand is not, the issue. It's supply side factors that we really need to be navigating through, and we're going to cover some of that later in the panel discussion, and then equally, pick some of that up in the Q&A towards the end. So let's turn briefly to M&A and what's been happening in the sector in terms of deals. Matthew Hogan from BDO is just going to start that session, just talk us through what we've seen in terms of activity. So Matt, over to you.
Thanks, John, and thanks again, Noble, for your insight from the latest CPA forecasts. Mantis, next slide, please. Thank you. So 2021 was really a year of record-breaking volumes internationally in terms of M&A activity. We had over 1,300 transactions completed globally, with volumes well above pre-pandemic levels. This was partly reflecting a catch-up in activity from the lower activity we saw in 2020 through COVID, but also reflecting a boom in private equity interest, which we will cover later on in this webinar, in a sector that was really highly resilient through the crisis. In the UK, transaction volume rose by 51% year over year, with 375 transactions taking place. The interesting part of that was the timing of those transactions. It was particularly skewed towards Q1, evidently a hunger to do deals early on in the year. We had over 150 transactions completed during Q1. Over 40% of those were private equity transactions in that Q1 period. And despite ongoing challenges that Noble has covered and will cover later in the webinar, we expect M&A activity to remain consistent with the back half of 2021, which saw approximately 75 transactions take place per quarter. Next slide, please. So just reflecting the international picture, the US led the way in terms of transaction volumes last year, which reflected an 81% increase on the previous year. So plenty of activity in the US and the UK. That said, the vast majority of deals are still domestic. Over 90% of deals are domestic. The outlier there is Swedish-based companies as a buyer, choosing a number of cross-border transactions. Next slide, please. And just reflecting on what's happening by transaction type, we saw manufacturing-related building products business transactions, return to pre-pandemic levels. But the interest in distribution and service-led businesses really surged, which continued a trend that has been evident for really the past decade. Service-related deals were a major component of Q1 volume as well, with 63 deals taking place in that first quarter. And the service sector also included several large transactions during the year. An example of that was in August, when TDR Capital and I Squared Capital paid £2.3 billion to take temporary power provider Aggreko off the stock market. And that represented an EV multiple of 11 times.
Next slide, please, Mantis. So just kind of what does this mean for the valuations? So despite kind of the uncertainty created by COVID and the macro factors, we actually saw M&A multiples hold up really well against kind of pre-pandemic levels, as kind of the transaction volume reached all-time highs in 21. So that the trade multiples, really held strong. And interestingly, what we saw was The listed groups, obviously, with the onset of kind of COVID, went through an initial shock phase, but recovered very quickly, and also went from strength to strength, reaching kind of 12 to 13 times during this year. Trade buyers faced increasing competition. So in 2021, PE continued to grow their share of deal value and deal volume as well. And particularly there was kind of pent up demand, there was dry powder to deploy, but also I think it reflects private equity kind of being attracted to the growth opportunities in the sector and kind of the strong fundamentals really. Against this was also dynamic that the public markets were outpacing deal multiples, so increasing that was seen as an attractive exit offering, meaning trade buyers had to price more competitively as well. And what do we see in terms of multiples? Private equity and trade kind of on average were around the 7 and 8 times, very similar. And I think this reflects the kind of underlying desire, appetite, and actually belief in the fundamentals of the sector in general. I think naturally the question is, can these strong valuations continue? I think Noble's touched on there's a number of headwinds which obviously we need to think about, which should complicate the kind of positive outlook. But overall, we think that the positive drivers, so ESG, automation, digitalization, those businesses which are resilient and have continued to do so, do well in the pandemic, will drive and support deal activity over the coming year. So moving on to the next slide, please. This just touches on kind of the breakdown by subsectors and what we're seeing kind of in valuation terms and volume. So last year was an exceptional year for M&A activity in general. This was spread across all the subsectors, which all saw year-on-year increases, and many actually had record levels. And across the 11 subsectors we have, most saw increase in valuations at the same time as well. The most active sectors we saw were merchants and distribution, kind of HVAC and plumbing, as well as access and lighting. On the flip side, the kind of relatively less high volume were the kind of windows and doors, and the flooring and kitchen and bathroom sectors, but still saw kind of 20 deals respectively. Overall, we think the deal environment continues to be strong. There are headwinds. Will we see the 2021 levels? Probably unlikely, given last year there was the spike caused by the rumoured CGT increase. But nonetheless, we see deal activity continue to be supported by the strong market fundamentals and the positive drivers. How that will impact the individual subsectors, it's difficult to say. There's lots of drivers here, ESG, digitalization, etc., which will touch on each other subsectors differently. But it's interesting to see, or it will be interesting to see how each other subsectors adapt and innovate to these. Thank you.
Okay, thanks, Matt. Thanks, Alan. So, the sort of deals market in rude health, really, both in terms of volume and pricing, and private equity has clearly had a huge impact on that. So let's look at private equity a bit more. And for this session, we welcome Neil from Cairngorm, and Matt's just going to lead us into this.
Thanks, John. So yeah, I mean, private equity plays a huge role in M&A in general, and that's also the case within the building product sector. There's still a huge amount of money within the PE funds that's seeking a home, and in particular, so following COVID, a resilient home at that. Our analysis of transactions has shown that, sort of, in addition to increasing overall deal flow, there's been a trend of private equity investors showing increasing interest as well. Last year showed a huge increase in the number of PE-backed deals, with a 92% increase from the number in 2020, which has been fueled in part by a number of sort of buy and build strategies from PE houses. So private equity deals in total accounted for 3% of all UK sector deals in 2021. And as Alan touched on, sort of average multiples there have been about 7.9 times EBITDA. So yeah, PE investors are clearly at home in the sector, and they see plenty of opportunities for creating value and continuing their sort of portfolio building. So on the panel today, we've got Neil McGill from Cairngorm, who's very well placed to answer the question really as to why PE are so keen on the sector. So Neil, if you don't mind introducing yourself and sort of picking up on that point.
Thanks, Matt. Morning all, and thank you to BDO for inviting me on this morning. So I work for Cairngorm Capital Partners, and we've got a number of portfolio investments within the building materials space. There's a number of principals within our firm who have actually operated in that industry historically, so it was always one of the original core sectors that we were focused on when our fund was set up. So just to give you a flavour, in our portfolio we have a general builders merchant business in the south of England, which is probably one of the largest independents at sort of north of 600 million of revenue. That's IBMG. We own a specialist timber processing distribution business called National Timber Group, which is a national player, north of 300 million of revenue, and I sit on the board of that company. And we've created that through buy and build and 7 transactions to date. We also own a paint distribution company, Paintwell, in the northwest of England, which is small but perfectly formed and growing through new branch opening and potentially acquisitions in the future. And finally, we own a fire door manufacturing business in Yorkshire called Sentry Doors.
Thanks, Neil. So in terms of sort of businesses in the sector, what is it about business models that are so attractive to PE?
Well, in terms of why we're quite keen in the sector, as I explained, obviously we've got a few people within our firm who've got direct operating experience, but why within the UK sector do we want to invest in it? I think there's a number of long-term trends that we are investing behind. If you look at the UK, clearly we've got pretty old housing stock, and there's a structural undersupply of new houses getting built. And that applies to private residential and also social housing in the UK. So that all calls for the repair, maintenance, and improvement of that housing stock. So RMI is a phrase I'll probably use quite a lot in the next little piece. So I think the RMI market in particular has proven to be pretty resilient across several economic cycles, and the number of investors, not just us, have seen that. I think that's leading to a number of private equity houses wanting to invest across the sector. Other long-term trends would include probably a shift away from DIY towards do it for me. Now that probably flipped on its head a bit during the pandemic as everyone was stuck at home and doing their own DIY. But I think the longer-term trend is that that's the case, and therefore that talks to businesses supplying products, B2B businesses in particular, who are serving and supplying products to tradesmen who can do that work. In addition, obviously, you've got the shift towards modern methods of construction. It's been long talked about, and there's been quite a bit of inertia over a number of years, but I think we're getting to that inflection point and potentially past it, where industrialization of construction, I think, has to make sense going forward. And so you've got businesses who are trying to take advantage of that, whether they're supplying components, modules, or offsite manufacturing. I think there'll be increasing investment there. And then you've got the energy efficiency agenda, of course. So those who are supplying products that, whether it's supporting heating, insulation, cooling of commercial and residential housing, again, there's going to be increasing trends towards those areas. And then finally, of course, you've got things like long-term investment infrastructure, as Noble had said earlier. You've got some big infrastructure projects in the UK that have been ongoing and will continue to be in the future. Some of our businesses, including National Timber Group, it supplies a lot of timber-related products, such as panel materials, into big construction projects like Hinkley Point. We're one of the biggest suppliers of these materials into that project, like HS2. So that has been a positive area, and we think that will continue to be the case going forward. And then finally, of course, private equity people like us quite like fragmented industries where there's opportunity for plays such as buy and build, where you can build scale, and get the scale benefits from doing that. And some of the sectors, including builders merchants, which may have been consolidated in the past, there's still a lot of smaller independent businesses there where there's the scope for consolidation. So we can take advantage of that. So that's a number of the long-term trends I think that private equity houses like us have been investing in behind in the broader sector.
Thank you. Yeah, that's very interesting. And it sounds like the interest is there to stay. And as the buy and build strategies sort of play out, I think PE investors will be turning their attention to exit options, which if we move on to the next slide, we'll hand over back to John.
Yeah, so actually let's just go one more slide, please, Matt. So that was the private equity deal volume. So different forms of equity. So private equity, is clearly embracing the sector more than it has in the past. I think it's got over the kind of cyclicality worries, with some of the more positive things that Neil has talked about. IPOs have also made a comeback, so flotations onto the stock market. I mean, it was a record year last year, with 8 building products companies coming to market, which included CMO, and that was an online builders merchant, which was private equity owned. Neil, I was just going to sort of ask you have you thought about IPO as an exit for some of your investments, either now or in the future?
Yeah, I mean, I think it is very much an option. Some of our portfolio companies are relatively large and probably large enough to be of interest to the capital markets. I think in the immediate short term, it's probably a little bit more tricky right now, where capital markets are a lot of volatility in the IPO window. It's probably a bit more shut than it was at this point last year. But as you said, there were a number of IPOs. You mentioned CMO. There was Lords, which is a builders merchant business, which floated last year and got it away pretty successfully. And then I think if you look at some of those markets that have been established, those businesses that have been established on market for a while, specialist distributors like Howdens, which is a very successful business model and are well regarded by the market, then I think there is institutional investor appetite for the right businesses and the right business models to come onto market. So it's something that we obviously continue to think about and monitor. At the same time, there's other exit routes open to us. We're concentrating on building the best businesses that we can, and that gives us as many exit options as possible. But we're not the only private equity funds looking at this market, and there's others there as well. So that might provide exit options for some of our businesses. And likewise, there are a number of trade players, strategic buyers who are remain inquisitive on market as well.
Yeah, thanks, Neil. I think it all points to continued activity, really, in terms of deals. So, private equity, capital markets, and trade. Let's move then just to sort of look at what lies ahead. I mean, as we sort of come out of COVID. So on to the next slide, please, Mantas. I mean, I guess COVID had a very unexpected impact. In the first few months, we can all remember sites were closed. Deals disappeared. Kind of wondered what was going to happen, and it just came roaring back, particularly with RMI spend. On as people sat at home on sort of improving houses and the like. So Neil, I mean, as you kind of build some of your independent builders merchant group, for example, what are you navigating through at the moment? What would you say are the sort of big issues for you?
Yes, it's definitely interesting. I mean, I think businesses are getting used to dealing with big macro shocks and issues, and of course you're not complacent, but they seem to come along one after the other at the moment, a bit like buses. But so it's been quite a change. I mean, if you go back to 2020 and the early stages of the pandemic, the thing about construction generally is that it was actually classed as an essential industry, so it didn't actually have to close, unlike others. However, a lot of businesses, including the ones we own, thought it was the right thing to do to close most of our operations for at least a period. The timber group I sit on the board of, we closed, we've got nearly 70 sites across the UK, and we closed every one of them for a period, which was quite scary at the time in April 2020. I remember that. when you've got all of your sites closed. But the reality was that we were allowed to operate, once we had safe working processes in place in the interest of our employees and our customers. We were able to get those sites open again. And the reality was, as you've mentioned, John, that it actually bounced back pretty quickly as, RMI spent, people sitting at home, they wanted to put some decking down, landscape their garden, extend their house, spending more time working from home. Then that led to a pretty big rebound during 2020 and then into 2021. So 2021 was an interesting period. Demand was very high. You had other dynamics, which Noble's touched upon, around shortages of materials and inflation of materials as well, which played through. We were trying to obviously make sure that we were able to pass through input cost inflation where we could. I think we were maybe helped by the demand side being quite strong last year. So quite a number of our businesses did trade quite well last year. But then we come to the current day. I mean, in many ways, that's history now. And I think the reality is you've got a changing macro picture, of course, for all of us. I think the concerns or the clouds on the horizon would be, the cost inflation piece, and therefore what that means for disposable income of households going forward. So, there's questions there. On the other side, you might argue that, there's pretty much full employment in this country. Household balance sheets, and I know it's maybe not all households, but maybe there's still a lot of household balance sheets are relatively robust right now. There's full employment, and there will be probably some wage inflation coming through, which of course is positive and negative, to some extent. But I think it's a balanced picture of what's going to be interesting this year is what happens with demand and volumes. The first quarter this year for a number of our businesses was actually very strong on a like-for-like basis compared to the first quarter of 2021, which is. But I think the question is what's the end of this quarter, Q2, and then the second half of this year going to be like from a demand perspective? And I think Noble set it out already. I think it will differ across different segments of the wider markets. I think RMI, traditionally has been pretty resilient. There may be some slowdown in last year, which is very strong, but then there's going to be other segments such as infrastructure, industrial, which is a bit later in the cycle, which should do better this year. So that's what we're looking at. We remain watchful, but at the same time, for a number of our businesses, we've got pretty established platforms, and we still think there's opportunity to continue to invest in behind good management teams and potentially buy more businesses, tuck in bolt-on acquisitions to some of our bigger platforms.
Okay, no, thanks, Neil. I think on the whole, that sounds, that definitely more on the positive side. Matt, I mean, you're working with a number of building products companies at the moment. What are you seeing?
Yeah, I'd sort of mirror the comments from Neil there, really. Looking back to that sort of first lockdown period when the guidance wasn't clear, a number of our clients did shut their sites. So the impact was pretty severe in those first 2 to 3 months, but actually sort of demand and activity quickly came back after that point. So we've worked with a couple where actually looking at their trading, it was the March to May period in 2020 was well down, but then sort of onwards from there, the processes quickly started up again, and it became easier to assess what the sort of ongoing EBITDA would be. And looking back today, as more time passes, given the building product sector was perhaps not quite as impacted as some other sort of sectors like hospitality, where additional lockdowns caused impact, it becomes easier to look back at what that normalized kind of profit figure should be in a process. But there's still other knock-on impacts which we're sort of getting challenged on processes. So whether it be ongoing supply chain issues or inflation, means that buyers are sort of paying increasing attention to those raw material prices or ability of businesses to pass on those cost increases to their customers. And then a lot of attention goes into sort of balance sheet as well. So stock holding and what is a normal level of stock for a business to hold. So there's still various complications in an M&A process, but in terms of recovery in trading, largely came back quite quickly.
Good. Okay. Thanks, Matt. Thanks, Neil. So we're just going to broaden that out now to look at some of the other themes in the sector. And welcome back, Noble. for this discussion. So Mantis, if we just pop on one more slide, please, and one more. Thank you. Great. Okay, so these are some of the themes we explore in the publication. There are 6 of them on that page. We haven't got time to go through them all, so we're just going to focus on sustainability and shortages, and we've had some kind of debate on that already, but just to take that a little bit further. So sustainability, Noble, if I start with you, what are your thoughts on, it'd be great if you could expand a bit on, you know, how you think that's impacting and how it's likely to impact going forward.
I think there are 2 perspectives from the sustainability and ESG side of things, which is that going forward, I mean, so far and going forward, it's investors who have been driving ESG, and because it's investors rather than a government doing it, it's actually occurring. Investors tend to be far better on delivery than government these days, and so it is very clearly occurring already in many sectors, and it is becoming more and more embedded within the industry throughout the supply chain. The key will be how to get not just the main contractors, main house builders involved, but the whole supply chain and the smallest contractors involved. So that's from the investors driving the ESG sustainability activity, demanding more as clients side of things. From the industry generally, sustainability, government clearly has its targets for net zero, and as I mentioned, government not great on delivery, policy delivery, but also delivery on any of its targets, whichever party political affiliation you have. But we're clearly trying to drive things forward in terms of movement towards net zero, and a part of that is decarbonising the energy network, but a lot of that has been done already. Going forward, you're going to have to look at retrofit, and it's a challenging area because you're looking at how you retrofit an existing housing stock of 29 million homes, around 80% of which are more than 40 years old. And so there is an awful lot of activity that will need to occur, and that's just solely on the residential side. There's also the non-residential side that will need retrofitting as well. So what that means is that, as negative as I've been around some of the uncertainties near term in construction on the supply side, there's not only strong demand at the moment, but long term there is going to be strong demand there, driven by sustainability across the agenda, whether it's on new commercial buildings, whether it's existing commercial developments driven by commercial developers and investors, whether it's on the residential side, the existing housing stock being addressed is clearly vital towards meeting the legally bound net zero targets, and it will provide a long stream of work in the medium term, but it does require government incentives for households to actually do the work.
Yeah, okay. Thank you for that. Neil, same question to you. How do you see it panning out? You know, Cairngorm view or impact on your companies that you're invested in?
Yeah, I mean, it's a major issue. We spend a lot of time, you know, I think like all private equity investors these days, thinking about ESG agenda. We think about how we operate as our firm, as a sponsor, and also how our portfolio companies are operating. I think there's going to be some commercial opportunities for some of our companies through all of this. If you take timber, which I'm also involved in, I think the stats are that there's 1 ton of carbon stored per meter cubed of timber, and that there's more carbon absorbed stored in timber than emitted during the whole process of harvesting, processing, manufacturing, transportation. So timber, I think relative to some other building materials, is seen viewed in terms of embodied carbon as a good thing, and that might be a tailwind over the medium term as to why there might be increasing use of timber in construction. So owning a timber company, maybe there is some benefits there, but obviously we have businesses that supply other building materials as well, and I think all businesses will be thinking about, and all manufacturers of building materials are thinking about ways of making their products more sustainable. And there's lots of interesting developments going on in other materials, including concrete and cement, traditionally pretty high carbon intensive businesses, and interesting technologies, green cements and concretes and things like that getting developed. Probably early stage, but I'm sure there'll be lots more development going on in a lot of these areas going forward, and some interesting business models and products will arrive in all of that. And then the other area, of course, that we have to think about hard across our businesses is what we're doing. We've got a whole range of initiatives that we're trying to roll out, from electrification of our fleets. A lot of our businesses have lots of trucks and vehicles. We're looking at electrifying them. We're thinking about the energy efficiency of the buildings that we operate from. Of course, you've got to think about chain of custody and sustainability of the sources of some of these materials, whether it's timber and where these things are getting grown and harvested. So we spend a lot of time thinking about that, and now I think just that'll increase going forward, because all of us want to make sure that the businesses that we're running are doing things in the right way to support this wider agenda.
Yeah, I guess that as they've all kind of outlined, that pressure will come back down the supply chain. Yeah, so the larger groups, putting a lot of demand might lead some of this stuff, but ultimately, kind of everyone has to get on board and adapt to some of these things. So on product innovation, Alan, you dealt with a business called Prolectric that was doing solar powered lighting powers. Tell us a bit about that, please.
Yeah, that's quite interesting. So we advise kind of the sale of Prolectric to Hill & Smith. So they specialize in sustainable lighting, for example, solar powered lighting towers into range of end sectors such as construction and infrastructure. And I think the interesting part of it here is kind of the growing awareness of ESG and how it's transitioning through in terms of awareness within kind of organizations and the levels. So for example, when the guys kind of initially kind of brought that technology to market, it was going up against your traditional diesel lighting towers, and the people they'll be speaking to be the environmental teams, and then the actual decision makers would be kind of the procurement teams. And in early stages in 2016, when that first kind of was brought to market, it was not getting the traction as kind of, for example, now going to market would have. And what really helped open the door was doing some detailed calculations with the kind of the procurement teams to show them not only obviously there are environmental benefits to this, but actually on a P&L basis, there's a lot of benefits here. So for example, with solar lighting towers, you don't have the maintenance, the diesel and the servicing. The payback is relatively quick, within a year or two, and then you've got the life of the asset from then. So you can see kind of how, they've grown awareness, the agenda is driven kind of at all levels now, and it's throughout organizations, it's on people's mind. And this is just going to be more and more important going forward, and how the whole awareness is changing as well, and decision-making processes.
Yeah, thank you. The thing that struck me was that payback point, really. Look, if you can rent a solar lighting tower, pay back in a year, and then you've got 10 years, the life of the asset, that is quite extraordinary in terms of economics. So it's, you can create advantage through these things as well, financially, as well as, the cost of sort of change and adapting. Should we just quickly flip to predictions? So Mantis, just the next slide, please, before we go to the more general Q&A. Noble, could I ask you first, please, your predictions for the rest of the year into next year? I guess you touched on some of that stuff already, but just...
Yes, as you said, I've touched upon it already, but what I would say is that there's very clearly strong demand currently. The projects already in the pipeline suggest strong demand going forward for housing, RM&I, till at least the end of Q3 into the end of the year. The key issues are going to be what the impacts of the cost of living crisis on households are going to be. But as Neil highlighted, I think the key issue is around unemployment there, because there are two very different groups of households. Poorer households, who tend to be renters rather than homeowners, they spend a higher proportion of their income on food and energy. They are likely to be very badly affected by this, but they don't tend to be the ones who are home buyers and the ones doing major renovations projects. The better off households tend to be homeowners or potential homeowners. They spend a lower proportion of their income on food and energy, where the inflation impacts are going to be greatest. If they're office workers, they tend to have spent parts of the past 2 years working from home, and so have built up savings. According to the Bank of England, they've accumulated over £200 billion worth of savings. So the key issue for them will be whether they feel confident enough to spend that. So unemployment increasing or not will be the key driver there of whether we see a slowdown in spending from that group, because if it doesn't, they do have the finance available. Looking into next year, there's still strong demand in sectors like infrastructure, industrial, commercial fit out is very strong as well, and changes in use of commercial developments to residential or industrial warehouses. So next 12-18 months, there are quite a few uncertainties there, but still very strong demand. And then looking longer term, there's still very strong demand for new homes. There's strong demand, as we mentioned, around sustainability and retrofit of the existing housing stock. Government has its idea of levelling up, and whatever that means, you're still looking at little bits of infrastructure around the country. So rather than big one-offs, so you are looking at significant construction activity there as well. So all the key drivers long-term are towards significant increases in construction. And then short-term, demand is strong, but there's lots of uncertainties there.
Yeah, no, well, thank you. I mean, the personal savings point is a really interesting one, those record levels. And the thing that kind of occurs to me is that, you know, with high inflation, the real value of money is eroding. You know, low interest rates still. I mean, in my mind, that points back to equities. You know, that people kind of, that group of people might be more inclined to sort of invest in the stock market, or you know, and we might see some benefit in private equity. Neil, would you agree with that as an equity investor?
Yes.
Yeah.
No, I think that's probably right. Yeah, you know, if I look at it from the private markets perspective, you know, there continues to be some quite punchy fundraisings going on. Some of the large cap funds are completing very, very large funds right now. And then you've got, of course, some of those funds and others thinking about how they can actually start tapping into retail investors for private market funding, and some distribution channels are opening up there as well. So I'd like to think there'll be continuing flow of capital into private equity. But I think, in terms of predictions for the year, I've got nothing further to add in terms of the macro picture. Noble's covered all of that. But you know, I think because of there has been a flow of money into private equity over the last few years, and that seems to be holding up, then, you know, there's lots of liquidity. I think that'll mean that there's still, therefore, scope for more transactions during the course of this year. I think, as Alan said, I'm not quite sure there'll be quite as many deals in terms of volume as 2021, which was pretty exceptional in most sectors, but also in this sector for a number of factors. But I think the deal activity should remain relatively robust, despite the macro picture looking a bit more murky than it was 6 months ago. So, you know, people have money to invest, and I think they'll continue to put their money behind good existing platforms where they've got a good management team, and they want to continue to back them to build their businesses. And that's the case for some of our businesses. Our builders merchant asset, IBMG, we've done 12 deals since October last year, and we've got a big pipeline. So I think we'll keep going because we've got a good team and a good platform in place. I think the other thing, just in terms of predictions, just to note that we maybe haven't covered is that, one thing that a lot of people did during the pandemic, if they hadn't, a lot of people are thinking about this already, is that you were thinking very hard about the efficiency of their business and looking hard at areas such as digitalization and automation. Whilst maybe some people are forced into that, I think it's meant that businesses might be a bit more resilient, even if the market does get softer this year, going into the downturn, depending on where they sit in the value chain. But I think there's going to continue to be an increasing shift towards businesses thinking very hard about how they can automate, how they can be more efficient, how they can use technologies to do all of these things. So I think that's going to be an ongoing thing, not just for 2022, but that's an ongoing trend I think that we'll see.
Yeah, no, thank you. We definitely agree with that, and we've seen that in a number of our clients, looking at that very agenda. Okay, look, thanks very much. Just in terms of the last few minutes then, Matthew, Hokum, anything coming through on the general Q&A that we could put to the panel?
Yeah, thanks, John, and thanks to again the audience for participating in the Q&A. John, probably a question for you in terms of M&A related activity in terms of these key market themes. Are we seeing any correlation between the multiple paid versus how advanced businesses are along these key market themes such as ESG and technology?
I think there's definitely a premium coming in for ESG. I think we saw that, for example, with the Prolectric transaction that Alan talked about. Investors have got, particularly capital market investors, but I think private equity as well, have very much got ESG on their agenda. Same as large corporates. So if they can buy a business that they can demonstrate to their stakeholders, it's got a more developed ESG offering. Both in terms of its DNA or its product or its services, and I think that will attract a premium valuation. Yeah, that most definitely.
Great, thanks, John. Question for Noble. We touched in your slides on the increase in contractor insolvencies. Few questions around that, I guess. How far do you see that going as a trend? What support is there or should be there for those contractors, and ultimately what does that do to confidence in the sector?
Okay, that's a good question. I think the insolvency number does tend to bump around from month to month, but there is likely to be an odd situation this year where demand continues to be very strong, but insolvencies are increasing. And I highlighted the issues around materials prices, but for specialist subcontractors that have been on fixed price contracts for the last 12 to 24 months, it's the impact of materials price inflation combined with labor inflation, especially in those trades where there are skill shortages. So you're looking at bricklayers, carpenters, drywall contractors, and some specialist engineering occupations as well on the civil side of things. Combine that with rising personal indemnity insurance, IR35, reverse charge VAT, and red diesel rebate going. There is a bit of a perfect storm for specialist subcontractors. But before we get too gloomy about this, firstly, demand is clearly very strong. Secondly, some of the main contractors and the major house builders have been better at dealing with the build cost inflation than some of the specialist contractors. If you look at the major house builders last year, then they were able to maintain build cost inflation between 5 and 6%, which, given for the major house builders, they had double-digit house price inflation. That was okay for them, particularly given increases in land value as well. In terms of what government can do, there's not too much they can do. If anything, I would argue because of reverse charge VAT, IR35, the red diesel rebate going, I think they've unfortunately exacerbated things over the last 18 to 24 months. But I think, as Neil mentioned, there is a greater degree of resilience within firms. The vast majority of firms within the construction supply chain now, they've had to get used to dealing with big one-offs, but also taking some financial hits. So the smaller specialist subcontractors will likely encounter problems, and we'll see increases in those insolvencies. But the vast majority of the larger firms are a bit more flexible and a bit more resilient. And so they should be okay and be able to ride it out whilst these short-term issues occur, and then they will be better set for longer term. And it's just worth mentioning in terms of the outlook from an M&A perspective, we've gone through a 20-30 year period where we've tended to focus on sourcing things from the cheapest location. The more and more cost inflation, supply chain disruption becomes an issue, then the more medium term the supply chain is likely to focus on security of supply and sourcing, not just sourcing from the cheapest areas, in which case it does lend itself towards vertical M&A within the sector. And so that is a trend we may increasingly see over the next few years, just to ensure that you do have security of supply.
Yeah, I think that's a great point. I think we're just coming up to the hour, or we might just have gone slightly past it by a minute. I think we could go on for some time with these questions, but we're going to have to draw time, I'm afraid. But first of all, thank you very much to all the presenters. Noble, Neil in particular. Thank you very much for joining us today. For all of you that have dialed in and listened and asked us some questions, thank you. Hope you found it interesting and informative. There will be. I think we're going to send out a copy of the slides. We're going to send, this has been recorded, so I think you'll get a link. So if any colleagues want to have a look and weren't able to join, then you can share that with them. And lastly, I think there's going to be a link to download the report as well. So anyone who's dialed in, I think we've got your emails and all that will be coming to you. So thank you very much from all of us, and goodbye.